It began with a hammer and a dream, a tradition of trust crafted in gold. Today, that legacy shines brighter than ever.
Hello and welcome. Hi everyone. Today we will be discussing about the stock of Kalyan Jwellers and what I see through the lens for a 10-year tenure from today onwards. That what kind of return is expected out of Kalyan. So let me go through the F26 numbers. Uh, So Kalyan has recently shared an update of Q4 where they have stated as 65% revenue CAGR. Revenue growth has been factored is achieved for Q4 F26 against Q4 F25 last year. So considering that, I have plotted the revenues for FY26 that will be in range of 35,000 odd crores, and EBITDA is assumed at 7%, that will be 2500s, and the interest expenses will be 250 crores, depreciation will be 228 crore depending on the store count addition which they have done. So they have factored 20 store addition in Q4 itself, so that will be the additional depreciation impact which will be there. So in terms of PAT, if you see, they will be reaching 1363 as a PAT number, so 1363 PAT in F26. So basis this at a market cap of 44,000 crores, it is trading at a current P of 32. So in terms of P, it's quite cheap, assume, because of obvious two reasons. The P is ultimately the perceived value in eyes of investor. So the perceived value is generated through two things: the return earning capacity of a company, and second is the growth rate which company will be growing at a larger horizon. So in Kalyan, if you see, it is growing at a rate of 50% for past maybe 5 years, and now also it is assumed that for another 5 years the growth engine will cool down, but it will be in range of 20 to 25% CAGR. So that kind of growth at an ROC of 28%, which is right now, which will obviously increase with the SSG growth remaining in double digits, and also you have your operating leverage kicked in. So those things will ultimately help Kalyan Jewellers to build a strong case for a re-rating in the future, and they should re-rate. If you look at the Titan, which is the industry leader for jewelry space, it is trading at about 80 PE right now, because of these two reasons, that it already has achieved the operating leverage benefit, and also trading and also is great in capital efficiency by ROE, ROC, and also the margins equation, and also the stud ratio remain very strong case for Titan there. So, speaking of 10 years down the line, where I think Kalyan should head towards, so that's what I've marked. That 10% revenue CAGR for next 10 years is what I've marked, which factors in few things which I think of, and those things are ultimately the mm, basic things which should help Kalyan do this. is the store addition in first place, which is the supply side of it. Second is the international expansion, which are taking place, adding new geographies to the list, and also they're also planning regional brands uh, strategy, so that will also unlock a new market for them. And third is the gold rate, which will ultimately increase the realization. That is also a factor. And third is the brand equity. The Kalyan's trust in customer is built, and I think after Titan, nobody will hesitate to buy from Kalyan. If you buy jewelry, it's a matter of trust rather than where you are getting it cheap. So that's what Kalyan has achieved over the years. That's what the brand equity is. And third is the organized shift, which we are seeing on a continuous basis in the market, where the larger chunk of gold jewelries will be bought through organized players than the unorganized player through urbanization theme which is playing out in India. So that's for the revenue, where I have assumed roughly 11% CAGR and a 1 lakh crore revenue for Kalyan Jewellers. So that's the case for the revenue. Then EBITDA I have assumed at 9%. It can be a higher basis the stud jewelry mix, but I assume it at 9% with the kind of operating leverage which will be kicked in once the store count increases and also the revenue base for the existing stores, and square meter revenue will also increase with time, and the SSG growth remains in the triple digit for the longer horizon of these 10 years is what I'm assuming. Then your working capital linked to your revenue and store expansion, so that will require a higher debt laden company, which is same case with Titan also. They're also having huge loans on balance sheet. So Kalyan has planned to deleverage itself, but still I think with the store expansion and the revenue growth, it will require the GML to be at a very high level, and that's why I've assumed a 15% growth in the GML loan and the subsequent interest rate. Then you have depreciation. So depreciation, I have factored in that somewhere Kalyan will maybe taper down the growth expansion of the stores and mainly focus on increasing the area per store. But this has factored in that whole store will be depreciated by the 10-year end. Only new stores will be factored in for the amortization. So that I've almost doubled in next 10 years appreciation. Uh, that's where my major cash flows will be going in, which are coming from internal accruals. Then the PAT growth is at 15% CAGR for the next 10 years is a huge story in itself. I think 15% CAGR, a predictable growth rate to assume in any stock in today's day and age is quite compelling enough for the investor to not deviate from a stock. And I think after 2 3 years when dust will settle, then I think leaving the stock wouldn't be an option for a large investor or a long-term investor. So that's kind of stickiness will again helps the company to re-rate itself. And also, if you see that the promoters holding is roughly around 62%, which is great, assuming that company has not diluted much of the stakes, and also internal accruals would be more than enough to cover for the store expansion in future years. And even though promoter sells a 5% stake, it will remain higher and upwards of 50-51% of the holding, and also mutual funds and uh, institutions holding will also increase once it moves towards a large cap category, and that will help it re-rate in likes of Titan. So that's the theme. I think I want to play big on the predictability of Kalyan being Kalyan and doing unimaginable things, and whatever different initiatives Kalyan will take. Maybe Kalyan will enter into watch business, or maybe some luxury items, or something else. That will be the thing which we have to look for, and where we will say that now Kalyan is moving in the right direction, and that will be the time to increase the allocations to the next level where the unpredictability kicks in. Till now, we are factoring only the jewelry business and the studs business and the international business for Kalyan. But what else is there? What is unpredictability of things is not even factored in yet. So those kind of things will be the icing on the cake once it comes, and I think Kalyan should be able to surprise us with those things and think in the right direction in terms of capex allocation, and also uh, investing in the next gen thing, be it in terms of art, in terms of diamonds, where it is lab made diamonds are picking up, so they can think, rethink, and unthink those kind of strategies where they want to be at. And that's it. Meaning, thanks for listening, and I hope I could have been able to add some value to it.